Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment, the podcast. My name is Jeb Graham, here with Eric Wymore and Ethan Hutchison. Today, how you guys doing?
Hanging in there.
Good morning. Doing well.
Good morning. Doing well. All right.
Yeah.
That's right. We got springtime has sprung, so it's nice to get the warmer weather. Graduations going on. By the time people, actually listen to this, people will be graduated and will be well on the way to summer. So anyway, today I think what we want to talk about, and this is something that comes up a lot with people, I think specifically as they're younger and growing money, and even people when they start to retire, is studying kind of wealthy families and what do wealthy families, throughout their lifetime do differently to become wealthy than people that don't end up becoming wealthy. So, and I think a lot of people are fascinated. Obviously, the three of us are fascinated by it because this is the business that we're in. And we've watched a lot of people grow a lot of wealth over time. We have a lot of wealthy clients. And then we have a lot of people that are aspiring to be wealthy and that are kind of doing all the right things and that we're trying to help them do the right things for that to happen. So what do they do differently? And before we get into the habits of people that become wealthy over time, I think it's important to define what is wealthy, right? Because I think there's a lot of people that have a different interpretation of what being wealthy means in America. But according to Yahoo Finance, today, being in the top 10% of wealthy households generally means that you have a net worth of between 1.8 and $2 million. Okay, so that's to be in the top 10%. If you're going to be in the top 1% of wealthy people, according to Investopia, to be in the top 1%, estimates are generally around $11 to $14 million in net worth. Another conversation that I think people hear a lot, whether it's on the news, whether it's you're listening to a debate, is that there's there's been a lot of wealth concentration in the United States, specifically over the last 10 to 15 years. Right now, according to windfall.com, 30 to 32% of all wealth in the United States is held by the top 1% of wealth holders in the United States. So, interestingly, like when we start talking about who are these wealthy people, where do they come through from, what do they do for a profession? Most of them are not celebrities and professional athletes, even though most celebrities and professional athletes are multimillionaires. When you look at the bulk of multimillionaires in America, most of them are not professional athletes. So what careers and things do they have that are very, very common? Some of them are surprising. Some of them are not surprising. Engineers, we have a ton of engineer clients that are multimillionaires. But that was the first one that came up. Accountants and CPAs, attorneys, management and business professionals, small business owners, physicians. I think none of those are surprising. Oddly enough, according to Ramsey Solutions, another big group of millionaires are actually teachers. So teachers that basically were the millionaire next door folks that saved a lot of money. They retired, they have a pension, so they don't really need to access a lot of the money that they save. So they become wealthy over time. And I think really what we want to talk about today is that the bulk of these people that have become wealthy, whether they're the top 1% or 10%, the vast majority of them did not hit some huge investment that made them wealthy overnight. The vast majority of them had discipline, long-term thinking, and intentional financial habits over years and decades. So today what we're going to do is just kind of break this down in a couple different ways. But I think maybe we can start with Ethan. Let's talk about planning ahead.
Yeah, thanks, Jeb. And one thing you said that really stood out to me is not everyone who's wealthy hit a good investment, right? Like you might talk to your buddies on the golf course or in the beer league softball dugout. They're talking about the Bitcoin investment that they triple overnight or whatever, and that happens. And there is wealth that's generated from some of those things, but it's most of the people we deal with don't have that exact, windfall that happens, the lottery or something like that. So they're out there, but kind of coming back to talking about early planning and planning ahead. You don't plan to hit that lottery ticket. You don't plan to get that Bitcoin investment or whatever it is. You plan to not have those things pop up in your life. And so one very, very common thing that we have seen is the wealthy folks that we deal with in their 50s, 60s, 70s, and 80s, they started investing in their 20s. And they started when they had free cash flow or when they didn't have free cash flow, when they had debt, when they didn't have debt. Doesn't matter what they did, they started investing. Earlier the better. Investing outside of their employer plans. Everyone tells you to max out your 401k or get the match and then do a Roth IRA. And there's all these sequence of events and ways to save. The reality is every family is different. One year you might have a great year. You could max out your 401k that year. The next year you have your second or third kid. Daycare's tight. You can't max it out that year. So there's a lot of things and discipline along the way that these wealthy families have learned, and it's been a struggle. It's not overnight. They're wealthy. They have taken time and methodically thought about this. Saving outside of your traditional 401k at your employer is huge. We work with a lot of families that have tax problems or tax considerations down the road where they might have a very large required minimum distribution. Let's say they've got 5 to 6 million in an IRA, all pre-tax. They live off $100,000 a year, fairly simple lifestyle that they live. When they become RMD age, they're going to have to pull out $400,000 to $500,000 of RMD. They need 100,000 of that. So they're literally pulling money out of their portfolio simply just to pay taxes because that's the way the tax code is written. So the strategy we have for them is Roth conversions. When we're doing those Roth conversions over time, you've still got to pay a little bit of tax over time. We're just helping minimize taxes in the future. How do you pay for that? A lot of times it's cash on hand, withholding, or like a joint or a brokerage account that these clients have saved in over time, and they have ample amounts of after-tax money or post-tax money, and tax diversification is huge. So not only just doing what you're supposed to do and saving into that 401k, but branching out and looking at asset location, tax diversification, Roth conversions, charitable giving strategies. There's a lot of common themes that these wealthy families have, and they're all kind of thinking about the same thing over time. The last thing I have is what we've noticed is they have a lot of systems in place. I'll sit down with an engineering client and they've got 7 tabs open on their Excel spreadsheet, right? And they know their budget, they know hypothetical growth rates of their portfolio, when the ESOP comes out, when the dividends hit. They are buttoned up systems, very, very well in place. People that are very wealthy are organized. They know where their documents are. If we call them and say, hey, can I get a copy of your 401k statement? We have it in 5 minutes. They know where their things are at, and they're conscious of where they put things. They have a team behind them. So we are financial planners. The cool part about our job is we get to work with CPAs and we get to work with attorneys. And our clients come to us and they might need referrals for those individuals. They might already have a team that they work with. And sitting down and strategizing as a group and as a team, I think is very impactful. It might not mean we're sitting in the same meeting for an hour or whatever, but we have an open relationship with these professionals and we can talk about these clients together. Estate plans are being reviewed often. This isn't hey, I got my estate plan done in the 80s, it's good. No, it's every 5 years or so as kids move out of the house, as grandkids come into play, as homes are purchased in different states. As the life gets more complex, that estate plan evolves. So making sure they're staying on top of that. There's a lot of other things, that people that are wealthy have done, whether it's liquidity events. But the main thing that we've seen is discipline and just taking the time to ask the questions and understanding the strategy. And those folks typically have a very, very high likelihood of being that wealthy family that we talked about a little bit ago. So, Eric, what's another big difference? How do wealthy families approach investing? Are they always hitting the lottery? Are they always hitting Bitcoin? What's kind of the investing realm that they live in?
Very good question. So no, I think the wealthy families, they think long term, right? They are really making decisions that are based on decades from now, not just quarters from now. Really have that long term focus of what's this look like in 5 years, 10 years, 15 years, 20 years, and so on. They try to remove that short-term emotional decision when it comes to investing that, really can set them up for making some mistakes. And so, the big thing that they also do, and keep in mind, all of these traits and habits are available to everyone. This isn't some kind of special sauce that's being created that's only available for certain people. It's available for everyone. And I think that's something you need to keep in mind if you're the average investor, so to speak. And but they prioritize ownership over consumption. I mean, they're certainly going to have that average mindset is, hey, spend first, invest second, where the wealthy families, wealthy investors are going to buy assets first, then live their lifestyle second. They're going to focus on asset allocation. They're very well diversified. Okay, they're going to own the growthy stocks and bonds for some kind of stability, but they're going to have international. They're going to have emerging markets. They're going to have some real estate in there. Wealthy investors or families also have businesses, right? Not every business makes money, but they also a lot of times will have a business or two or another way to create some kind of income. They'll have some private equity. Potentially they'll have some, different types of structured types of investments that they'll look into, tax efficient investments. So they're just very well diversified. And the reason for that is when the markets are kind of volatile, they don't have to panic, right? Wealthy families need money just like everybody else, but they always have a place that they can go, sell something that's not necessarily down. Because the worst thing you could do as an investor is have to sell something when the market's down 10, 20%. Wealthy families have somewhere to go get the funds that they need to pay for whatever lifestyle they need. They're certainly not asking, should we get out? They're asking the question, do we need to get in? Are we looking for opportunities to be buying at this price? That's a big difference between some of that average mindset and the wealthy family mindset. I think the other thing that they really value is, or look at, is they really avoid that get rich quick mentality. Ethan, you mentioned it, the lotto ticket. I'm not saying they don't buy a lottery ticket when it's, $1 billion, but but they don't necessarily worked up about if they miss out on some kind of like crazy crypto type of investment, right? They're not in it for the short term. They make investments with a bit of skepticism, right? They want to make sure they use the old adage, if it sounds too good to be true, it probably is. They want to see the results before jumping in, and they realize that it takes time, and that's the value of having patience that they have. It's the compounding strategy of investments, that compounding takes time. It's not something that happens in necessarily one generation. It might take 2 or 3 or 4 generations to really create that type of wealthy family. And again, I'm gonna mention it again. All of these habits, all of these traits are available. All these tools are available to everybody. It's not a special secret for the wealthy families. But Jeb, maybe you can kind of share a little bit more what they look like when they use money as a tool, and some of the other things they do.
One of the things I took, Eric, from kind of what you were talking about there for sure is the pay yourself first, right? And I think that discipline is such a big discipline. I want to talk about a few different books, just for listeners that if you're kind of wanting to read, ones that kind of maybe were impactful in my life or just that I thought were very interesting. But one of them, to what you were talking about there, is called The Richest Man in Babylon. It's literally like a 30-page, super easy book, old school, but literally the theme is that, the richest guy in Babylon back in the day, no one could figure out how he was rich. And then basically as he got old and he explained it to everybody, it was that he would just take 10% of everything he earned, and he thought that was his for the rest of his life. And then everything else he spent. So basically paid himself first, 10% of his income. I always thought that was a good book. Super easy read. One called Die with Zero, a little bit different. People might think that that's a book that is geared toward, basically being frivolous and spending everything in your lifetime. It's not. It's really about the max utilization of your money. So basically, you've earned and saved all this money. Is basically get that utility out of it in your lifetime. So if you want your kids to inherit a bunch of money, it talks a lot about gifting and giving your kids money during your lifetime. So you actually get to see what they're doing with it, as opposed to you die, they get money, and then basically you're not around to kind of see what transpires there. Always love that book. Millionaire Next Door is another good one. It's older and there was a couple variations of it after the original. But it just really talks about, kind of like in the intro when I was talking about, what professions are actually millionaires out there and where do they live and all that stuff. And it just kind of talks about habits of people that accumulate wealth over time is a great book. And then Think and Grow Rich. That's kind of that's more of an out there book, but it's a great book. It's almost kind of like The Secret, where it's talking about people that whatever your most predominant thoughts are the things that actually begin to transpire in your life. But that was a good book that I had read back in the day. And then Rich Dad Poor Dad. I think Ethan, you had said you had read that one as well. But really the theme there is ownership. And I think both Eric and Ethan and your guys' segments were talking about wealthy people own things, right? Whether it's investment accounts, whether it's businesses, whether it's real estate. But Rich Dad Poor Dad's really about the fact that, wealthy people have an ownership mindset and they want to own things. And that's one of the things that makes them become wealthy. So, and to your point, Eric, there about treating money like a tool, I think, in the wealthy people that we know that we work with, the one of the themes is that they value time over stuff. Okay, meaning what they want to do is they're not really focused on impressing people, but they want to use money to create freedom and flexibility, and they invest in experiences in their life. Okay, meaning maybe that $20,000 vacation that some people think is blowing money. They would value that as a way to connect with family, a way to see and experience things that they haven't seen before. And I think that's a very, very common theme among wealthier people. So when I say investing in an experience and relationships, we're talking about travel. We're talking about family memories. We're talking about helping children become responsible. And then, lastly, and I don't think we've hit a lot of this, is philanthropy and community. And I think there's a big notion out there that people start giving to philanthropy once they become wealthy. And there's a lot of studies that say that people that are wealthy that give to philanthropy did that well and long before they became wealthy. It was something that they made a part of their lifestyle when they were younger. So anyway, lastly, I'd say that most, when you're talking from a family perspective, a lot of them have kind of a long-term family vision, which is they have intentional conversations with their kids about money and about values. They definitely teach kids about money and the power of saving and all that, which is why a lot of times families become wealthier over generations, is because that trait is passed down and taught. They prepare heirs, that are going to inherit money. A lot of them want to gift it over time so that heirs don't just get a big chunk of money at one point in time, and they let them ease in to having that wealth as opposed to having a big windfall. And then also creating purpose around wealth. A good example of that would be, a family that has a vacation home or a lake house, and really so that's something that they needed money to purchase, but really the value there isn't the home, it's the memories that are created, it's the fun that's had, and it's all that stuff. So I think that's common themes with a lot of people that have money that we work with. And what else, guys? I think we hit on a lot of the major things.
Yeah, and I think you hit on it, and it's worth repeating. And we've said it before. I mean, I think when we're doing, the financial planning on things, and we're, all right, what's your, monthly expenses needed, and here's all the other income sources that you have, and here's the projected returns of your investments, and this is what we need to take out for, each month or each year to live. And then you get the exciting part, and like, hey, I'd like to take my family on vacation.
Mm-hmm.
You're like,
Yep.
now we're talking.
Right.
Right.
We heard from our guest Aaron Clark. I mean, you're gonna work 90,000 hours roughly, in your job, and you're gonna create this net worth and all the investments that you've done a good job of saving and squirreling away. And man, what a memory you get to create when you get to take your family on a vacation, or you're gonna, like you said, you buy that second home. So all of a sudden it's not, to show off your money, but it's a gathering place for your family to come and make those memories together. And that's the best part of our job, is getting to plan for those situations. Yeah.
And when
for
you
sure.
when you remove the facts, and like when you're sitting down with the family for the first time, you can tell a lot about them when you ask them what's important to them. And if they say, "Oh, I want 18% returns guaranteed," blah blah blah, and you kind of know, what's probably behind that curtain, versus someone who says, "I just want time to spend with my family while I'm here." And you get those two polar sides of that conversation. And sure, returns are important. I'm not trying to discount that, but the way that some of these families answer that question, you can really tell a lot about what's behind that curtain.
Yep. 100%. Yep. They want to know that their money's in a good place so that they can live their life. Right. And that's kind of where they're at. So
yeah, they're more focused on what's the next thing, what's the next thing they get to do.
Mm-hmm.
Right. What's the next experience?
What's the next experience? What's the next trip? I want to plan this trip to Italy. I want to plan this, this vacation with the kids.
Yep.
That's what they're wanting to do.
Yep. 100%. Well, this has been a great conversation, and I know we're kind of running up on time. So good conversation, and, we'll see everybody next time. This is Metcalf Money Moment Podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.